I have a market prediction tool for this very point in time that I want to share with you. I've got many indicators that I use for watching the market: listing versus pending ratios, inventory, absorption rate, days on market. There's just so many that I use, almost like an airline pilot's dashboard. But if you're a carpenter and you got a lot of tools in the toolbox, you want to know which one to use for the job. Well, there's a great tool that I'm going to share with you for this point in time. So before I do that, if we haven't met, my name's Gary Nims. I'm with Windermere Real Estate. I'm taking a casual Friday. So there's a great tool that I'm going to share with you here. But before I do that, let me just let you know the Fed met last Wednesday, January 31st. They decided to keep the federal funds rate unchanged, steady. They're not raising it. They're not lowering it. However, on Thursday, the average 30-year interest rates dropped 12 basis points. That's a pretty good drop. The market's gaining confidence that rates are going to settle down. Now, today's Friday. It's the end of the day. We got a favorable jobs report, and that wasn't favorable with the market in terms of interest rates. So there's going to be some turbulence, but it's becoming more and more evident that the direction that we're headed, those rates are going to be coming down. So the Fed's not talking interest rate increases. They're talking about timing of reductions. That's what's on the table, and that's what gives us confidence. But before I show you this indicator tool and where to find it, I just want to take 30 seconds to remind you why interest rates are so important. And I'm going to use the 1 in 10 rule. Generally speaking, if mortgage rates increase 1%, your purchase power is going to be reduced by 10%. Okay, generally speaking, rule of thumb. So if you were looking for $1 million home, now you're looking for a $900,000 home. But the inverse is true. Rates drop by 1%, you can afford 10% more house. So something that's really key to understand is that the more affordable homes become in the Pacific Northwest, the more competition that you're going to find. The more you're going to have less confidence that your offer is going to be accepted. Worse, you'll have less contingencies, potentially inspection, appraisal safety nets, and so forth. So this special report that I'm doing for you is to let you know that it's starting to get competitive out there. Just this week, I have a colleague who listed a home for $850,000. They're under contract at over $1 million right now. They waived all contingencies, and they're moving towards closing in just a couple of weeks. This isn't happening everywhere, fortunately, or for every home. But if you wanted to wait until the market reached the bottom, I'm sorry, it's too late if you didn't buy in 2023. There's still a lot of room to go, though. So here's why I'm confident that home prices are going to increase. Number one, they've increased since the beginning of time. So it's just the general direction of the market. And then number two, the very thing that's putting downward pressure on the market, on median price, starting to relax. That's interest rates. So there's this organization that's called the CME Group. And to introduce them, I'm going to use their own language. The CME Group is where the world comes to manage risk. So their explanation of their process of why they have this algorithm, they say the 30-day federal funds, futures and options, are one of the most widely used tools for hedging short-term interest rate risk. Federal fund futures are a direct indicator of the future course of the Federal Reserve's monetary policy. What does that mean? It just means they created an algorithm for giving us odds about the future federal funds rate. I just call it following the money. So let's look at this in real time. I'm going to share my screen with you. So just sharing my screen, what I want you to do is type in the CMEgroup.com. Okay. Now it's going to take you to this site right here. So then you're going to click on markets up here. Now come down to interest rates. And then you're going to go to tools. Okay. Now, once you get to tools, it's going to take you to, I mean, there's all kinds of stuff you can splash around in here if you really want to geek out on this, but you're going to go to CME Fed Watch. So I'm going to click on that. Okay. Now that's going to take you to this portion on their site where it talks about the Federal Open Market Committee. The next meeting is in 46 days. So I'm just going to read this part to you right here. What's the likelihood that the Fed's going to change the federal target rate at the upcoming FOMC meetings? Okay. So here is the tool that you can use. And they got a bunch of tabs here. These are the upcoming FOMC meetings, the Fed meeting. Okay. And right now, we're looking at the current target rate. Okay. So they're saying that in March 20th, when they meet again, there's an 80% chance that they're going to keep rates the same. Okay. Look at the probabilities right here. No change. Okay. Let's look at May. We're looking at a 60% chance that they're going to reduce by 0.25%. See, we look at June. There's a 55% chance that they're going to be, remember we started at 5.25 to 5.5. There's a 50% chance that we're going to drop down 0.5 point. We get to July. There is a 47% chance that we're going to be down 75 basis points or 0.75%. And you can get into September, November, December. You look at by the end of the year, there is a 40% chance that we'll be down. Where were we at? 5.25 to 5.5. We're going to be down 1.25% interest in interest rate. Okay. That is going to open up the market. Okay. And then we can keep, we can keep going with some of their prediction tool. But I'm just saying, just like the stock market and the bond markets, they price in the direction they think the economy is going to go, very broadly speaking. Buyers make decisions on their confidence in the direction that the market is heading. So when interest rates start peeling back, you're going to see buyers start jumping in strongly. So there is a lot of pent-up demand. A lot of folks want to get in their first home. A lot of folks want to move up to a larger home. A lot of folks want to move down to a more manageable home. So a lot of folks are watching for the right time to jump in. I can tell you that you missed the friendliest waters, but there's still time. Here's what I want to ask you, though. This is the question. A year from now, are you going to be one of those people who think, man, I really feel like we missed the boat? Or are you going to look back a year from now and say, I'm so glad that the market is working for us instead of against us. What a relief. We're in a great home. So answer those questions. What's best for you and your loved ones? I'm Gary Nims with Windermere Real Estate. I really appreciate you watching this special report. Feel free to pass this on to your friends. Take care and good luck to you.